In this session, we are going to look at the three major aspects relating to the probabilistic approaches in decision making, wherein we are quickly looking at scenario analysis and the decision trees and spend some time in Monte Carlo simulation. So, just one slide will quickly run through what is scenario analysis and decision trees. Then we'll spend some time looking at what are the steps that are involved in running a simulation procedure. Three different ways to define the probability distribution in case of simulation. What are the three different mechanisms to define the probability distributions? How do I really look at correlation between or among the various variables which are involved in the simulation process? Is it really beneficial to go ahead with the simulations for making decisions? We'll be doing a kind of a comparison analysis between the scenario analysis, decision trees, and simulations. Then, what are the common constraints when we are doing a simulation, especially for valuation purposes? What are some of the common constraints that we may have to get into? And what are the different issues that we come across, especially when we have to use simulation for the risk management purpose. So getting straight away, scenario analysis. We look at different possible scenarios of the inputs. Probably the worst case, the best case, the most probable case. We collect the inputs in all these cases and try to observe how the output variable is behaving in all these cases. What is the decision that is coming out in all these cases? And we actually contrast them with the expected value, what we really are going to should get and what is that we are getting in the best scenario, worst case scenario, or even some most probable scenario. When we are executing scenario analysis in the extreme case, we look at only the best and the worst case and contrast them with the expected value. But in the normal scenarios, we create few scenarios, 5, 10 scenarios of possible values of the input and see how the output is changing with respect to each of these changing input. So we take some optimistic scenarios, some pessimistic scenarios, some somewhere in the middle and see how the output changes with respect to the inputs. That is what goes into a scenario analysis. Whereas when we talk about a decision tree, it's more like a phased wise kind of sequential kind of a decision making. So it is more and more appropriate for sequential risks and discrete risks. So either this can occur or this can occur. The probability of this occurring, probability of this occurring. If this occurs from here, again there could be a chance of this occurring or this occurring. So this is what is a decision tree coming up, which means every phase is actually captured. We look at the probability of occurrence of each of the phases, and this way the decision making that we are getting into is what is called as a decision tree approach. So it is giving me a complete assessment of the risk, and it also helps me to come out with the optimal course of action. Okay, at the end of this phase, should I go forward to the next phase, or what is that I should do, or should I cut my process at this particular stage itself? And even it helped me to find out the expected value of the asset. Probably if you remember, the binomial tree based pricing of the options is more and more based on this kind of decision tree kind of an approach itself. Even the base way of decision making comes with this kind of an approach itself, right? So we can try to find good number of applications in the world of finance and investments which are based on this decision tree kind of approaches. Now, coming to simulation, it's more and more flexible, especially if there is a lot of uncertainty in the input variables. If you remember the scenario analysis, we said we'll take the worst case, the best case scenario inputs and then observe the output. But why only these two, or why only these few? Why can't I look at all possible values of the inputs? Now that is where the simulation comes in more and more handy, because we are looking at the distribution, the probability distribution on how each of the input parameter can change. I'm not just taking one or two possible values of the input, but I'm trying to understand what are the possible values of the input, what is the distribution of the input variable. So for each parameter, growth rate, I'll look at what could be its distribution. Market share, what is the distribution of the market share? Beta, what is the distribution of the beta? And based on all these things, I am running a simulation procedure. So the typical steps, there are 4 steps involved in simulation. First, identify what all variables you want to model. Growth rate, market share, beta, what is that you really want to model? Get the list of all the variables. Here we really don't have any kind of a constraint on how many number of variables that you want to choose. You can choose 1, 2, 10, 20. But remember, the only problem comes is the technology, the processing time. The computation time will be extremely high when you are running simulations on multiple variables compared to running it on one single variable. That's the only constraint, but there is nothing else that is stopping you from deciding on the number of variables to consider for your model. But whatever the variables you have considered, we are defining the probability distribution for each of the variables. So some of them could be discrete distributions like binomial, Poisson, negative binomial, geometric, whereas some of them could have continuous distributions like normal, log normal, gamma, beta kind of distribution. So that's where we may have a differentiation. We have to try to identify the probability distribution for each of the variables. And if there are multiple variables in our model, it's better that we see if there is any kind of intervariable correlation that is being present. And if it is present, obviously even that correlation needs to be considered as a part of the model. And once we have set these 3 things, we will start running the simulation. So we'll take the inputs, characteristics of the probability distribution, and based on that we try to compute the output. And how many simulations we have to run is purely based on what is the level of accuracy or what kind of error tolerance we are planning to have. So the higher and higher the simulation I am running, the number of simulation runs are higher, the accuracy is higher, the chance of error is much lesser. Now, in the step 2, we said we have to define the probability distribution for each of the variable. There are 3 different ways in which we can define this probability distribution. One, based on the historical data, especially when your data is having a long history and lot of reliability for that historical data. When I look at a long-term treasury bond rate, I have it for last few decades. So I have a lot of historical data, and that historical data is more and more reliable. But one thing when we are using the historical data is there is no structural shift. We are making a very blunt assumption that there is no structural shift. So which means there is a kind of mean reverting behavior. So it is more and more a stationary kind of a process. So these are some of the assumptions that we are implicitly making when we are using the historical data to develop the distribution. Otherwise, we are using the cross-sectional data. If we don't want to use the historical data of that same entity, we can take the cross-sectional data wherein the differences of the specific variables across all the entities is what we are getting into the is what we are using as an input into the model. So what we are simply assuming here is all the competitors data that I am using is a good indicator of the uncertainty for my particular variable. The third is a statistical distribution, which is going pure and pure on a theoretical basis. I don't have the historical data. I can't use the cross-sectional data. Then I am using the statistical distribution, where I am assuming that a particular distribution is more and more appropriate for this kind of a data, and based on that I am trying to find out the correct set of parameter values, which obviously would be a difficult process. So this is purely a theoretical kind of perspective, where I am assigning a statistical distribution under the theoretical understanding of a particular variable. So these are the three different ways in which I can define the probability distribution for the variables in a simulation. And if there are multiple variables, obviously I can't treat them completely independently. There might be a lot of correlation that might be present between the variables. So it might be very well possible that the variable 1 and variable 2, probably let's say the interest rates and the inflation, nominal interest rates and the inflation, they might be strongly positively correlated or negatively correlated. Whatever it is, they might be correlated, they may not be independent. So if they are very much correlated, either if I consider both of them as a part of my model, then it is like a duplication. So either I consider only one of them into my simulation model and ignore the other, or all we are saying is build this relationship also into the model. So the moment I got the value of the V1 through simulation, let V2 not be an independent one. Let V2 be generated based on the value of V1. So that is where you can take the correlation into consideration into the model. If you remember, this is what we call it as Cholesky decomposition, where while generating the random variables per simulation process, we can consider the correlation between the variables also through this process of Cholesky decomposition. So, but we require more sophisticated simulation packages. We may not be able to do this entire process manually. But how the correlation is changing, how much should be the correlation between the variables, I can very well get it from the historical data, and based on that correlation I can very well incorporate, I can compute the value of one variable based on the value of the other variable and then take it forward. Now, does it really make sense to use simulation in the decision making? Now, some of the positive things about it is, yes, the inputs can be estimated much better. I don't just take the best case value or a worst case value and look at my decision. I look at the entire distribution of input values and see how the output is changing. So output is not one single value. The output is a kind of a range of values rather than one single point estimate. So I really, for the inputs also, I really don't need to rely on one or two values, and output also I don't need to really look at only one or two. I get a full picture of the entire distribution of the input as well as the distribution of the output. So this is helping me in understanding the broad perspective of my inputs as well as my output. That's the kind of an advantage that I can expect using simulations in the decision making process. But at the same time, we cannot say that simulation can lead to better decision. Simulations will give me a better picture, but it can't lead me to take better decision. It gives me an enhanced value, enhanced way of looking at my inputs and the outputs, but my decision is not improved in any way through the simulation process. And the other important thing we should also understand is, so simulation is actually giving me a better estimate of the expected value, but it's not that it is superior to that of any conventional risk adjusted value model. It is only giving me all the possibilities, but it's giving me a complete distribution of the inputs and the outputs rather than one single input or one single output. But it is not that it is giving me a better estimate of the expected value. It is expected value, it is not changing. Expected value might still be the same. But what is changing is it is giving me the range of possible values that can come up so that I can take my decision accordingly. So it can aid me in a better decision making, but it is not doing any kind of a better decision. And when we are with respect to the valuations and all, we may have a few constraints which we may have to explicitly take, like book value related, regulatory capital constraints, requirements should be there. Negative book values of the equity we may have to consider based on the historical data itself. There could be a constraints with respect to the earnings, the cash flows, the market values. All these constraints need to be very much incorporated into the simulation model. You can't make them vary as we like, right? Some of them need to be fixed. Some of them need to lie in within a particular range. So those kind of constraints we cannot make them alter as a part of our simulation approach. But one thing, final issues wise, if you look at, the good is garbage in, garbage out. Means if our inputs, so if we have understood what all inputs should go into the model, if we have identified the distribution of each of the inputs properly, then we can expect the output also to follow a better model. So what we give as an input, how good are our inputs will determine what is the goodness of the output in case of a simulation model. And we need to understand that the real data, whatever we get from the market, it is very difficult to fit it perfectly to a given distribution. So there will be some amount of error or a deviation from a specified distribution. So that is one more issue. So I can't use the theoretical distribution as it is to do my modeling. Many a cases my distributions could be non-stationary in nature, which means there could be a drift component, right? Probably if you look at the stock prices, there could be an on an average growth rate every year. Apart from the volatility part, there could be a constant growth that could be there year over year. So the market structure itself could be shifting either up or down. So those kind of things, again, how we incorporate into a simulation process would be another challenging part. So if there is no mean reversion kind of a behavior, how do we incorporate those things as a part of our simulation process is something that needs to be understood. And the correlation between the variables, even that is not stationary. In some point, at some points in time, the correlation is much higher between the variables. Some points the correlation is much lower. So how do I really incorporate the changing correlations across the inputs as well? So all these things become challenges when we are performing simulation exercises. Now, just a quick comparison between the three approaches for decision making: the scenario analysis, the decision trees, and the simulation. So, first of all, selective versus full risk analysis. In scenario analysis, I am considering few of them: best case, worst case, most probable case, a few scenarios I'm looking at, and based on that, I'm doing the risk analysis. Whereas in decision tree, I'm looking at all possible outcomes where I'm converting my continuous risk into a set of possible outcomes. So I'm simplifying the risking procedure here. Whereas in a simulation, we are finding out the probability distribution of all the input variables, correlation between the various input variables, and trying to capture all the possible outcomes that can come out under each of the possible combination of the input variables. Coming to the risk type, in scenario analysis and decision trees, we look at the risk type to be more of discrete outcomes. So they are very better off for concurrent risks occurring at one single point in time. Obviously, the decision trees can also be useful enough for sequential risks as well. But simulations are more and more targeted toward the continuous risk, which means even if the risks are one following the other, or even in case of simulation, even if they are concurrent risks, I can very well go ahead in terms of performing a simulation and trying to take my decision accordingly. Coming to correlation, obviously simulation, we have seen that the correlation can very well be incorporated between all the variables using the Cholesky decomposition kind of mechanism. When in case of scenario analysis, we have to create explicit scenarios which can take into consideration the correlation between the various variables, but nothing of that sort is possible in case of decision trees. So that's how we look at these three different tools that are available for decision taking. And it's a very simplified article which is focusing on a comparative approach to these three different kinds of tools. If you have any further queries, you can very well get back to me by giving me a call on the number that I have provided below, or send in an email at vamsidhar@facegurus.com. Thanks a lot for listening to this session. Thank you very much.